Today, we're digging into a fascinating analysis that says almost everyone is getting the silver market wrong. You know, it looks calm on the surface, but is there a storm brewing just underneath? Let's find out. All right, I want you to start with just one number, $80.69. At the time of this analysis, that was the price of silver. Now, I want you to burn that number into your brain, because by the end of this, you're going to see why our source argues it's one of the most misleading numbers in finance today. And that really gets to the heart of the matter. When you see a price just bouncing around in a tight little box, day after day, week after week, is that just boring consolidation? Or is it something way more powerful? Is it compression? So here's how you can look at this. On the left, you've got what pretty much everyone sees, a stuck, boring, range-bound market. Nothing to see here, right? But the claim we're exploring today is totally different. It says what we're actually looking at is a coiled spring. That huge, powerful forces are converging, literally squeezing and loading energy into this market for a massive move. Okay, let's unpack that. First up, we're going to dig into why our source thinks this $80 price is basically a lie and reveal the one crucial piece of context that it says most people are completely ignoring. And here it is, that number. As of this analysis, silver is trading almost 34% below its all-time high of over $121. And get this, that high was hit just 11 weeks earlier. So an asset hits a record and then, boom, drops by a third. The big question is, why? And this leads to the most important point of the whole argument. The fundamental reasons silver got to $121 in the first place. You know, the supply deficits, the insane industrial demand, all of that is still here. In fact, it might even be stronger. The argument is that the only thing that really changed was an outside shock, the outbreak of war. This just shifted the timing of the next move, not the ultimate destination. All right, so that brings us to the next piece of this puzzle. The analysis we're looking at identifies three huge, distinct macro forces that it argues are all pointing in the same direction, right at the silver market. And here's the roadmap for that. First, you've got the immediate geopolitical stuff. Second, and this one's a biggie, you've got the Federal Reserve trapped in what's called an impossible position. And third, you have this slow motion crisis brewing in the actual physical silver market. Let's really break down that second force. Okay, so according to the source, the Fed is stuck between a rock and a hard place. It's a classic policy trap. If they jack up interest rates to fight inflation, they risk tanking an already fragile economy and sparking a debt crisis. But if they do nothing, they risk stagflation. That's where inflation stays high, but the economy is weak. It's a terrible scenario, and historically, it's been incredibly bullish for precious metals. And if you're wondering if there's any history to back this up, well, the source points to one heck of an example, 1979. The last time the US was in a real stagflationary mess, silver went on an absolutely legendary run. We're talking from about $6 an ounce to almost 50 in less than a year. Now, they're not saying it's going to be an exact repeat, but it shows you what's possible in this kind of environment. Now, for that third force, and this is where things get really interesting. The source argues that there's this huge, growing gap between the paper price of silver that you see on your screen and the actual reality of what's happening with the physical metal. The analysis boils it down to one critical ratio, 7.5 to 1. It claims that for every single ounce of real, physical, deliverable silver sitting in the COMEX registered vaults, that's the stuff that backs the whole futures market, there are 7.5 paper claims on it. That kind of leverage is at the absolute heart of this whole coiled spring idea. And here's the problem. That little pool of physical silver, it's been draining fast. The COMEX inventory peaked at around 200 million ounces back in 2021. Today, it's collapsed by over 61%, down to just 77 million. So the actual physical backing for that 7.5 to 1 paper ratio is just getting thinner and thinner every single month. Now, you're probably thinking, well, why don't they just mine more silver? Ah, but that's the catch. Silver supply is what economists call inelastic. See, about 70% of all silver that's mined comes as a byproduct of digging up other stuff, like copper or zinc. So even if silver's price went to the moon, a copper miner isn't just going to double their output to get a tiny bit more silver. You can't just flip a switch and make more. So you've got this fixed supply on one side, and on the other, you have this relentless wave of what the source calls unstoppable structural demand. This isn't about whether people are buying jewelry. This is built into the future. We're talking solar panels, EVs, AI data centers, 5G. All of these things need silver to function. And that demand is only going one way, up. It's just putting more and more strain on a supply that can't keep up. Okay, so that is the huge big picture thesis. But what does it mean in the real world? How do you actually use this information? Let's look at the practical framework, the key levels, and, just as importantly, the risks that the source lays out. So here's the roadmap the source lays out on the charts. To the upside, the first big test is 83.50, but the real game changer would be a break above $91. That's the level that would basically kill the current bearish chart pattern. And on the downside, your first line of defense is around 78, with a major long-term support way down near $63. But to be fair, the source is really good about laying out the honest bearish case too. And this is super important. The Fed could just stay tough on inflation. A more aggressive Fed chair could take over. All that leverage in the market could actually work in reverse and make a sell-off even worse. And, technically speaking, that bearish chart pattern is still in play until it's decisively broken. These are the real risks you have to watch.
Okay, let's pull all these threads together. The entire analysis really culminates in one central theme, one big idea that reframes how to think about everything we've just covered.
This source gives us this really smart framework based on time horizons. In a very short term, say the next 48 hours, it's all about geopolitics. In the medium term, maybe the next 3 to 6 months, it's a Fed trade. It's all about inflation and interest rates. But over the long term, 1 to 3 years, it becomes a structural trade based on that physical supply crisis we talked about. The key is knowing which clock you're playing on. And here it is. This is probably the single most important line from the entire analysis. The big drop from the all-time high, that was a reaction to a change in timing, driven by events overseas. But according to this source, it did not change the ultimate destination that the physical market fundamentals have already laid out. Which brings us right back here, to this number. The source's argument is that you shouldn't see this as a 33% drop, you should see it as a 33% discount. A discount being offered on an asset whose fundamental story, they argue, hasn't just stayed the same, but has actually gotten even stronger since it hit that record high. And so that leaves us with this final, powerful question. If the multi-year supply deficits are real, if the mine supply can't respond, and if the demand from new tech is unstoppable, then why on earth is the price 33% cheaper? That's the core puzzle this analysis wants you to think about.